All right, macro shock investors, buckle up, because a bombshell just dropped that could send shockwaves through the very foundation of the American tech industry and, by extension, your portfolios. We're talking about a move that could fundamentally alter how Silicon Valley operates, how companies innovate, and where they choose to invest. President Trump has just unleashed a colossal new fee on H-1B visas, a whopping $100,000 per year. Is this a masterstroke for American jobs or a reckless self-inflicted wound for our tech dominance? Let's dive in. So, what exactly went down? On Friday, September 19, 2025, President Donald Trump signed an executive action to impose a staggering $100,000 application fee for H-1B visas. This isn't a one-time charge, folks. Reports indicate it could be an annual fee, drastically increasing the cost for companies to employ highly skilled foreign workers. For context, the previous total fee for an H-1B visa ranged from $2,000 to $5,000, making this a truly monumental hike. The administration's stated goal is to curb what it calls overuse of the program and incentivize companies to hire American workers. President Trump also introduced a gold card immigration pathway, fast-tracking visas for individuals paying $1 million or companies sponsoring workers for $2 million. The immediate reaction from the mainstream media and industry leaders has been swift and largely critical. Outlets like CNN and LiveMint are reporting widespread condemnation, with many calling the fee hike reckless and warning of a huge negative impact on the IT sector. Microsoft, a major recipient of H-1B visas, reportedly issued an advisory to its employees in the wake of this announcement, signaling the seriousness with which companies are viewing this development. This move is being seen as the latest and perhaps most impactful step in a broader immigration crackdown by the Trump administration since January. Companies like Amazon, Microsoft, Apple, and Google have historically been among the largest sponsors of H-1B visas. Now, let's talk about what this means for your money. This isn't just a political headline, it's a massive market-moving event, especially for the tech sector. Scenario 1. Severe disruption and cost surge, 50% probability. In this scenario, the $100,000 annual H-1B fee proves prohibitive for many companies, particularly smaller firms and startups that rely on specialized foreign talent. Companies find it extremely difficult to absorb these costs, leading to a significant reduction in H-1B applications and a severe talent crunch. Expect significant downward pressure on the S&P 500 and particularly the Nasdaq. Technology, being a heavily weighted sector, would drag down the broader market. Growth forecasts would be revised downwards due to reduced innovation and increased operational costs. Specific market sectors: technology, software, IT services, cloud computing. This sector would face the most direct and severe blow. Companies reliant on a global talent pool for specialized software development, AI research, and IT services would see their costs skyrocket. Innovation could slow as finding and retaining top talent becomes more expensive and difficult. Consulting and professional services. Firms that provide IT consulting and other professional services often leverage H-1B visas. They would see their margins squeezed and their ability to staff projects with the best talent hampered. Major well-known stocks. Microsoft, MSFT. As a top recipient of H-1B visas, Microsoft would face substantial increased operational costs and potential delays in critical projects. This could impact their cloud, Azure, growth, and software development. Amazon, AMZN. Amazon, especially its AWS cloud unit, is a massive user of H-1B visas. The fee hike could significantly increase costs for their rapidly expanding tech workforce, potentially impacting profitability and future expansion. Google, GOGL. Similar to Microsoft and Amazon, Google's extensive R&D and numerous tech initiatives rely heavily on skilled foreign workers. A talent squeeze could hinder their competitive edge and product development. Tata Consultancy Services, TCS, and Infosys, INFY. These major IT service providers with substantial operations and employees in the U.S. on H-1B visas would see a dramatic increase in their cost of doing business, directly impacting their profitability and potentially their stock prices. Scenario 2. Moderate adaptation and innovation shift, 35% probability. Here, larger, well-capitalized tech companies adapt by either absorbing the increased costs for critical roles or shifting their hiring strategies. There's an accelerated push towards automation and potentially relocating some research and development or operational functions to countries with more favorable immigration policies. Smaller companies struggle more, but some find niche solutions or focus solely on domestic talent. Initially, there would be volatility, especially in tech. However, the broader market might show resilience as capital rotates to less exposed sectors or companies that quickly adapt. We could see a period of slower tech growth, but not a full-blown collapse. The S&P 500 might flatline or see a slight dip, while the Nasdaq could experience a more noticeable but not catastrophic correction. Specific market sectors. Technology. Companies with strong balance sheets might absorb the costs for critical hires. However, there would be a strategic shift towards more domestic hiring, increased investment in automation, and potentially expanding operations in other countries to circumvent U.S. visa restrictions. Automation/AI companies. Paradoxically, companies providing automation tools and AI solutions could see increased demand as firms look for alternatives to human labor. Education/vocational training. A greater emphasis on upskilling the American workforce could benefit education technology and vocational training providers. Major well-known stocks. Microsoft, Amazon, Google. These giants have the resources to adapt, perhaps by ramping up their global hiring outside the U.S. or investing more heavily in AI to reduce reliance on human labor. Their stock prices might see an initial dip but could recover as adaptation strategies become clear. Smaller tech startups. Many smaller tech companies could be severely impacted, struggling to compete for talent or afford the new fees, potentially leading to consolidation or slower growth. Scenario 3. Limited long-term impact, workarounds emerge, 15% probability. In this less likely scenario, the market finds a way to largely neutralize the impact. Companies might lobby aggressively for changes, or legal challenges could slow implementation. Alternatively, the tech industry quickly innovates around the restrictions, perhaps by focusing intensely on upskilling the existing domestic workforce or finding highly efficient and cost-effective ways to utilize remote global talent. Any initial market reaction would be short-lived. The S&P 500 and Nasdaq would quickly shrug off the news, continuing their trajectory based on broader economic fundamentals. Specific market sectors. Technology. The impact would be minimal, perhaps leading to minor cost adjustments that are quickly absorbed. Major well-known stocks. The performance of individual tech stocks like Microsoft, Amazon, and Google would largely be driven by their core business performance rather than the visa changes. So, what am I doing in response to this macro shock? Given the current uncertainty and the potentially severe impact on the incredibly important tech sector, my take is to exercise extreme caution and consider strategic rebalancing. While the market has proven resilient, a $100,000 annual fee is not a trivial cost, especially for a program that companies like Amazon, Microsoft, and Google utilize heavily. I'm not advocating for a fire sale, but this is a moment to reassess your exposure to companies with high reliance on H-1B talent. I'd be looking to trim positions in overly concentrated tech holdings that rely heavily on this global talent pipeline, especially if their valuations are already stretched. This isn't about panicking, it's about proactively managing risk in the face of a significant headwind for a dominant sector. I'd also be looking for opportunities in sectors less impacted by these immigration policies, or companies within tech that have a more diversified global workforce or are leaders in automation solutions. Now, let's look at the technical picture for the broader market, represented by SPY. My team tells me that SPY is currently in an uptrend after a recent breakout, with the next resistance level at 670. This is crucial context. The market has been showing strength, which is positive. However, this H1B visa news is a macro shock that could challenge that uptrend. We need to watch how SPY reacts to this news very carefully. If the market shrugs it off, the path to 670 might still be clear. But if we see significant selling pressure, especially in the tech-heavy Nasdaq, then that uptrend could be in jeopardy. A breakdown from recent support levels would indicate that this news is indeed having a tangible impact, and we might see a pullback before any retest of that 670 resistance. I'm watching for confirmation of continued strength or a clear rejection of recent gains. What do you think about this H1B visa fee hike and its potential impact on the markets? Are you repositioning your portfolio, or do you think the market will absorb this easily? Let me know your thoughts in the comments below. And if you're getting value from these deep dives, do me a favor and smash that subscribe button and hit the notification bell so you don't miss our next macro shock analysis. Remember, this is not financial advice, just my analysis and perspective as a retail investor. Always do your own thorough research and consult with a qualified financial advisor before making any investment decisions.